This episode is sponsored by Contentfy, a premium video editing and content repurposing service for busy content creators, influencers, brands, podcasters, YouTubers, and marketers. Contentfy provides unlimited end-to-end editing and repurposing services to help you get your video and audio content edited and repurposed quickly, easily, and reliably. Join other busy content creators, founders, brands, and marketers who now spend even more time creating while they take care of the rest. You no longer need to worry about spending hours editing anymore. Just create content, build your audience, and grow your business. If you're a content creator looking to save time and money, or looking to outsource your content marketing team, get your first free video edited now at contentfy.co. If you'd like to sponsor the SaaS District podcast or recommend any guests that you think would be valuable to be on the show, visit horizoncapital.com/SaaS-podcast today. Thanks again, folks. Hello, everyone. This is your host, Akil Jabbar, and welcome back to another episode of SaaS District. In today's episode, we'll be talking about B2B SaaS benchmarking and its impact on go-to-market team alignment. Today, we have our guest, Rike, joining us. Ray is the CEO and founder of RevOps Squared, a company that conducts benchmarking research across a wide variety of KPI categories in the B2B SaaS industry, which then enables SaaS companies to exponentially increase customer acquisition, customer expansion, as well as customer retention efficacy. So Ray has more than 30 years now in the SaaS industry. His passion for data-driven and metric-based decision-making has helped him succeed across 5 SaaS company exits, which we'll talk about later today. So welcome, Ray. Super excited to have you on SaaS District Show today.
Akil, hey, thank you for inviting me. I'm looking forward to our conversation.
So let's get into, specifically, talk about what exactly are, revenue operations, and, if I'm a B2B SaaS company founder, why do I need to think about these benchmarks? What do I look at this research and assessments and then think about it for my perspective?
Well, maybe I'll go back to my creation or vision for revenue operations back in 2008, which is when I first created this concept of RevOps Squared. And I'd been a longtime operator of marketing, sales, services, and then customer success organizations. And one of my biggest challenges was the integration and alignment of those 3 or 4 teams. And what I found was if we had shared goals that we all were measured on equally, and that was things like revenue outcomes, customer satisfaction, it would allow us to align our processes, our platforms, and our data internally. So RevOps is really an organizational strategy to align sales, marketing, and customer success to the customer journey. And if you have those 3 go-to-market teams aligned to the customer journey, I think you're going to dramatically increase your revenue growth performance and ultimately your company value.
Got it. And then, so what would you say, what are those metrics and benchmarks that these SaaS companies are looking at, whether that's their finance, their budget, or kind of helping them make decisions when they're looking at across kind of the whole business and team?
Yeah. Well, the reason we created our B2B SaaS benchmarking index was, once again, based upon experience, because our experiences do bias us, right? But they also hopefully inform us. So often I was brought into organizations that had already raised a Series A round. They were typically in the as small as 1 million, but 1 million to 10 million ARR range. And my, perceived expertise was scaling to 50 and then 100 million. And there you have to lay in a lot of processes, organizational structure, and discipline. And because I was brought up at GE, General Electric, in their executive leadership program, we were always told to make decisions with data. So when I walked into a SaaS organization, the first thing I did was understand what were our internal measurements and our key performance indicators that were being measured. As you can probably imagine at that stage, often they weren't very robust, right? They were focused on, we've grown 180% in the last year, and our average contract value is this, and our sales cycle is this. But I would always want to take the internal metrics and see how they compared to like company cohorts. or benchmark ourselves against other companies. Now, often you're biased only by your previous one or two companies, right? Well, we had a 28% close rate, so we should have a 28% close rate. Or our sales cycle was 120 days, so ours should be 120 days or shorter. But I always went out and I tried to find research that actually benchmarked companies like mine, my size, my average contract value, even my industry, because a marketing automation software company had different dynamics than a cybersecurity. And Akil, it's so hard to find that information. A lot of it's anecdotal, it's biased. And even I would sit in board meetings and a board member would say, and by the way, these were pretty well-known board members. Well, your gross dollar retention rate should be 88%. And I'm like, why do you say that? Because our product is 1 to 5K, right? Or we're at a $1 million. How do you know that that's what it should be right now? He goes, well, based upon my experience, you looked at their portfolio companies. It's like, we've got a few $20 million ones. You've got some product-led growth ones. So I said, the industry desperately needs benchmarks that segment the benchmarks by company size, by annual contract value or average annual contract value, by your go-to-market motion. Are you sales-led or product-led? If you are sales-led, what is your true distribution model? Is it inside sales? Is it inside plus outside sales? Are there channel partners, et cetera? Who are you selling to? Because these benchmarks are different if you're selling to an SMB cohort than an enterprise cohort, right? Fortune 500 buy differently than even mid-market. And even your funding source. Because if you're funded by a VC, they have different goals and metrics, and growth rate is one of the top ones, right? Then if you're self-funded and bootstrapped, you got to generate enough cash to reinvest it in growth. So your benchmarks are going to be different on things like EBITDA and Rule of 40. So that's what we're trying to do, is provide benchmarks that are relevant to your stage and your type of company.
Okay. So, if I have access now, you've kind of opened up the books and saying, look, this is all the data across the industry. I'm a B2B SaaS company, or I'm a board member. Now I can make better sound decisions because I look at ACV of my competitors. I look at their growth rate. I look at who they're targeting, all these kind of the metrics, which you kind of put together. Once I have that, what's typically the strategy that you're seeing people, adjust and make when comparing to the overall industry and, to leverage that information better?
Yeah. Well, there's no one size fits all, right? So it's stage appropriate, and it's kind of what's your overall strategy. So I would start with number one, never be a slave to one metric. Right? If you say, well, net dollar retention is all I'm interested in because I understand now that the correlation to enterprise value multiples is now higher for net dollar retention. So number one, at your stage, what are your company goals? And I recommend setting 3 to 5 max company level metrics and goals that are measurable and can be benchmarked. So if you're at an early stage, let's say you're in a post-seed, it's all about customer growth, right? It's the number of customers. You may be looking at average contract value. Maybe you're trying to go from 25K to 40K because that's going to increase your growth rate. So you need to understand what your goal is at that point in time. But what's most important to us with establishing these company level metrics is the entire executive team owns those company level metrics. So let's say for this year, we're looking at 60% committed ARR growth. We're looking at a net dollar retention of 106%, which means we need to have 70% of our growth coming from net new and 30% from existing customer expansion. Now, we've got those as a team. Now, every member of the executive team can have objectives that are measurable that have a direct causal relationship to those company level metrics. An example, if your goal is to grow your net new customer ARR by 60%, and that requires 100 customers, then marketing will say, well, my goal is I'm going to generate X dollars of pipeline from my marketing activities that results in inbound marketing pipeline. And that's a very tangible goal. It's not number of leads. It's not how many website visitors or how many webinar attendees. It's a dollar of pipeline and then a conversion rate. Because I should know for an inbound marketing lead that my conversion rate to a closed won deal is X percent. Where on an SDR outbound, my close rate for opportunities qualified is Y%. Then the CEO and CFO and the CRO can make smarter decisions. I'm going to invest an extra $1 million in sales and marketing this year. Where should I invest it? Today, Akil, so many companies say, well, we have a 70-30 split. 70% goes to sales and 30% of my investment goes to marketing. And then it's like, well, why? Because if I can get a higher return on investment as measured by not only close rates, but more importantly, CAC payback period, my CAC ratio, which says how much sales and/or marketing expense to invest for every dollar of ARR, you can make much smarter capital deployment decisions of where you put those investment dollars. And now, and I'm sorry, I'm talking a lot, but if you're getting ready to raise a Series A or Series B, that VC is looking at, if I'm going to invest $15 million into your company, how's it going to be deployed? What's the return on that $15 million, not only from a committed ARR, but also from a company value perspective, right? If you can go and say, here's how I'm going to allocate that $15 million, because historically, for every dollar of marketing investment, we've gotten 88 cents of new ARR. And for every dollar of sales investment, we're getting 92 cents. You can make smarter decisions.
Exactly. Yeah, I mean, that's exactly it. That makes perfect sense. And you just nailed something there specifically for when it comes to, raising your Series A. That's what really matters at that point, right? It's like you have to have your numbers dialed in and you have to show how adding fuel to the fire is exactly what you need to do. And by putting more money, you're going to get, putting X dollars, you're going to get Y out. And it has to be very, nicely shown and presented. And you have to have that data as clear as possible, right? So and that's super important.
Yeah. And then I find there's a lot of danger to metrics, right? So being a slave to metrics can be very dangerous. True. I've talked to multiple founders and CEOs over the last year who are getting ready to do a Series A round. So they raise seed. And as we know, seed is much different today than it was 5 years ago. So maybe they raised $1 to $2 million, right? At least in a seed round.
Yeah.
And they're saying, well, I'm being asked, what's my customer lifetime value to CAC ratio? That's one of the metrics, right?
Exactly.
But if you've only got 1 or 2 years of operating history, you're $1 million in ARR, you don't really know your customer lifetime value because it factors in your churn rate. And if you've only got one renewal cycle, right, going, so months 13 to 24, you really don't know what your churn rate is. So your customer lifetime value can be artificially high, as an example. So that's a metric that I'm like, yeah, don't worry about that until you've got 2 to 3 years of operating history, and you can really start diving in. What are the input variables that impact churn, thus customer lifetime value?
Yeah. Do you have any favorite maybe tools or softwares that you recommend to help keep track of all this data? Because I know there's Profitwell, there's a bunch of others, but do you have one that kind of combines it or something you love using yourself?
Well, there's two things. So number one, you've got to instrument and collect all your internal key performance indicators to get the metrics, right? So one of the tools, right, we're all biased by our experience, Insight Squared for a small to medium size SaaS company is one of the best tools I have because it takes all the information from Salesforce, from your marketing automation, and it does three things. Number one, it kind of tells you is your pipeline coverage ratio for the last quarter, the last 2 quarters. And then it looks at your existing pipeline, right? And it says, based upon your existing pipeline, here's how much we forecast that you can actually close in the next month, quarter, et cetera. Really powerful information. Number two, it actually takes event and activity-based information like, oh, you have a stage 4 sales opportunity, but you haven't had a meeting in 6 weeks. There hasn't been an email exchange. Those type of activity-based metrics are really important to the quality and thus the forecastability of an opportunity. Now, the third thing that I love to see is benchmarks. And I have not found a great tool for benchmarking. There are pretty good tools for metrics calculation. So Insight Squared helps you bring the data in. Tools like SaaS Optics, Sage Intacct, which is a financial platform, has a really nice metrics calculation capability. And there's a lot of these emerging FP&A tools like Calculate, et cetera. They're doing a real good job of calculating your SaaS metrics using industry standard formulas. But from getting benchmarks, it's been really fragmented and very manual. And that's what we're trying to build here at RevOps Squared is you can go onto our site, type in those 6 or 7 attributes of your company, and we never collect company-specific information. Because you said something earlier that is a fundamental value proposition for us. We're never going to collect individual data that's associated with your company name. Now, I know there's people out there like Nathan Lotka does a great job where he does his YouTube interviews. It's like, okay, I've got information from whether it's 20,000 interviews, et cetera. But most companies don't want to disclose, number one, their confidential metrics. And number two, how high of quality is that data, especially if it's 12, 18 months old. Because if you did an interview pre-COVID, those benchmarks and data is bullshit. They had no value because growth rates, customer acquisition cost, payback periods, they all changed dramatically in the last 6 to 9 months. So for RevOps Squared, we're trying to build that go-to destination where based upon your company attributes, you can see the benchmarks not only for the last fiscal year, but for the last quarter.
Got it. And so can you share a little bit, maybe not specifics, but where are you gathering your insights and research work, and how do you keep track over time, because obviously the SaaS market is expanding, so the size of your data is expanding, and then, changes are happening so quickly, with growth rates increasing year over year, and so many companies entering the market. How do you guys kind of keep track of that, and how are you addressing kind of those key points over time and keeping that benchmark, up to date?
It's the number one challenge with market research and especially SaaS benchmarks because it is evolving so quickly, and people are getting inundated every day with surveys, right, or research. So that is our biggest challenge, and if we can solve this, it's the biggest opportunity. So the first thing we're doing, Akil, is we're going out to other B2B SaaS companies who have products and solutions that impact one specific KPI or one specific process like customer acquisition. As an example, in partnership with Demandbase, who's one of the leading account-based marketing intent data firms, we collected about 40 data points on benchmarking the investment and return on account-based programs. Things like based upon company size versus non-account-based. What's the close rate for account-based opportunities versus non-account-based opportunities? What's the average contract value? So that's one KPI data set and benchmarks we have for account-based programs. Now we're doing one with Sage Intacct, the financial platform, and we're looking at the financial management process. How much time does it take to do your monthly closes? How much time does it take to calculate all of these metrics we're talking about? What are the source systems for the metrics data? So that's another benchmark category we're doing. We did one with Ring DNA, which is one of the leading sales engagement platforms out there, about customer acquisition benchmarks. How many outbound activities does the average SDR do to get one meeting? How many meetings does it take to have one qualified opportunity? What is the close rate of a stage 1 qualified opportunity to a win rate? So we have customer acquisition funnel benchmarks in concert there. The SaaS CFO, we're doing syndication of our company level metrics, the ones that create value, like Rule of 40, net dollar retention, CAC payback period. So our approach is a syndicate of partners who already have both customers and large marketing databases. They go out with us to create a market research report that becomes a content marketing asset that they can show their thought leadership and awareness. And then they can actually deliver that report through our platform in an interactive manner. And our benefit, instead of just having RevOps Squared going out there and collecting KPI data, we have now over 20 different companies that are going out and helping us collect data across currently 8 different benchmark categories, expanding to 14 by the end of the year.
Nice. Okay, so
so you look at any of the current market research reports, like I love KeyBank. KeyBank has for 12 years done their annual B2B SaaS benchmark report.
Okay.
12 years. Last year, they had 538 companies participate, and it doubled the previous year. It was a banner year. We've got over 10,000 companies to participate in our research over the last 12 months. And in our last kind of high-level B2B SaaS benchmarks, we had 748 unique companies, and it's only the second year we've done it. So it seems to be gaining momentum.
Love it. Yeah, I think data is, it's the most valuable piece right now. And I haven't heard about KeyBank, but I'll definitely check them out. For founders, maybe, SaaS founders listening in, and they look at data, they understand the value of making data-driven decisions, but there's always that kind of skepticism or fear to make those hard decisions, right? To help maybe improve their performance based on what they read. And the reason why I'm saying this is because if you make that wrong decision, even though it's data-driven, it can actually go the wrong way, right? Like, let's say, for example, you're saying, your LTV is lower than your competitors. And then you say, okay, well, maybe I need to increase my pricing. But then you're like, look, well, it's working. All these other benchmarks are doing fine. Yes, I need to focus and, maybe increase my LTV. But if I make that move, maybe it'll have the opposite effect. And then, you do all this work and planning and get the team online, your sales team, to adjust this new pricing. And then the fear is that it actually has the opposite effect, or just feels like there's more downside to maybe upside. What do you kind of suggest to them when you speak to them?
Well, first of all, I think fear is more based upon the unknown than the known. Mm-hmm. And being informed is never a bad strategy, right? So I would say at least be informed of what like companies, not necessarily your competitor, because you probably have a unique value proposition from your competitor, but from the cohort, you can say, hey, my CAC payback period for my size company and my ACV should be around 12 months at median. Now, I may make the decision to increase my CAC payback period to 18 months because I want to grow faster. So if I invest more in sales and marketing based on my historic evidence, it's okay. I'm going to take a hit on my CAC payback period, but in 24 months or 36 months, I'm going to have a higher committed ARR growth rate. So I say be informed of your cohort. Number two, make a decision with your team. Your executive team is responsible for executing the tactics to achieve those goals, right? So if you say, hey, here's what I think as a CEO, I think we should be focused on committed ARR growth this year. That's our number one goal. Our second goal is we want to make sure that we don't ignore our existing customers. So we want our gross dollar retention rate to be at 88%, which is kind of normal for my industry. And you got your executive team's buy-in. Now, everyone knows, number one, what my goal is. We all co-own it. And we think that it's at least reasonable because there's a cohort of other companies out there that's what they're achieving. How many times, Akil, have you seen a board of directors or a new CEO come on board and say, we've got to hit 50% growth rate this year. And now we're at 10 million versus at 5 million. And we only did 42% last year, and our cohort's growing at 45 to 46%. Maybe a 70 or 80% growth rate is not an achievable goal, but at least we're informed directionally by the benchmarks. Then when our team decides, hey, we're bought into those goals, and that's really important, the buy-in, then each of them have the responsibility to say, here are my top 3 to 4 measurable goals. And here, if I achieve those, here's how it impacts the company level goal that I just agreed to. So it's the cascading goals that we think is really important that CEOs and CFOs need to get buy-in on. Because Akil, we go back to the beginning of this conversation. I said I created RevOps Squared to help with marketing, sales, and customer success, alignment, integration to the customer journey. To me, that begins and ends with we have shared goals. We have departmental goals that have a direct causal relationship to those. And every time we talk about how our key performance indicators are trending, we know that we're reporting to the goals that we all agreed upon and that are shared in common. How many times do you see you hire your new CMO? You get your Series A. The CMO comes in, you've got to grow faster, and the CMO says, okay, I'm going to generate 50% more leads. That's what I need to do.
Exactly.
So, man, marketing invests a lot of money, a lot of demand generation programs, may tweak the MQL, and it's like at the end of 3 months, end of 6 months, look at me. I just generated 50% more MQLs. And the sales leader said, but my conversion rate of MQLs to a stage 1 qualified opportunity reduced by 32% quarter over quarter. And then they get into, well, you're not qualifying right, or you're not qualifying hard enough. And the salesperson says, your MQLs suck. It's like, wait a minute, guys. Our shared goal was we were going to increase our pipeline by $5 million last quarter, of which $2 million was going to be from inbound leads from marketing programs, and $3 million was going to be from outbound activity, $2 million by SDRs, $1 million by strategic accounts with the AE base.
Mhm.
Align, and agree.
Seems super important, but it seems so easy, right? To communicate it very, very clearly to everybody. But yeah, it's a lot harder when people have their own kind of agendas or plan, or when things are not communicated clearly, right?
So, Keelan, what we're doing, I'm a big fan of this concept of chief revenue officer.
Mm-hmm. Me too.
But my definition of a chief revenue officer is an individual and the associated organizations that are aligned and integrated to meet the customer journey expectations. But what's happening, if you really go out and say, Mr. or Mrs. CRO, what responsibility do you have? Oh, I run sales. Or, I run sales and customer success. Less than 50% of CRO titles have marketing, sales, and customer success responsibility. So to me, it's just a glorified title for a head of sales and isn't achieving the stated goal, which is to have true alignment integration of those three functions to the customer journey. That's a big issue out there, in my humble opinion.
I agree with that, definitely. Ray,
and then, by the way, let me add to that. And my point of that, so what, Ray? Well, the CEO, that was her job, right? Her job was to make sure everyone's rowing in the same boat in the same direction. And now it's kind of been outsourced to, well, I couldn't get marketing, sales, and customer success aligned, so I'll send it down one level. And that's what the CRO now needs to do.
Exactly. A lot easier for them to take the blame, right?
Yeah.
Yeah. So you've had, you said 5 exits with your SaaS companies. And we also talked about, from an investor perspective, what they look for when evaluating opportunities and what the key points maybe they decide on. So we talked about the, CAC to LTV ratio, and you also mentioned 3 to 5 ones that are really important. Do you suggest is there any that you suggest SaaS founders should really look at internally to make sure they calculate and benchmark their companies for improving their chance for whether it's investment or getting an acquisition?
Yeah, happy to do that. Of course, at the end of the day, any investor is looking at the market opportunity that a company is addressing, right? Some people will say it's got to be at least this large, because if I can't create $100 million or $1 billion company, I'm not going to do it, right? Of course, they look at the team, the quality of the team. So there's some of those things that everyone knows what VCs look for. But now let's take it down into what are the metrics, especially if it's more growth stage or even beyond growth stage into kind of private equity acquisition. What are those goals or what are those metrics? And they are stage appropriate. But number one, I look at the R squared, which is a logistical regression variable that looks at the correlation of a metric to enterprise value to next 12 months revenue. And of course, it's easy to see in public companies. 5 years ago at Q, rule of 40, which is adding your growth rate plus EBITDA, that was the number one metric that VCs looked at and had the highest correlation to the enterprise value multiples. Today, it's number 4. The number one multiple for more mature SaaS companies today is net dollar retention. Its R squared factor is 0.42, which means the closer you get to 1, the more correlated it is to your enterprise value to revenue multiples. It's number 1 today. So even though I wouldn't tell a seed stage company, look at NDR, or a single product company to look at net dollar retention, everyone should be thinking about, does my go-to-market strategy and my focus, how is it going to impact net dollar retention over 12, 24, 36 months? So NDR is very important. Committed ARR growth is number 2 from an R squared factor. It's around 0.29, 0.3. So you still need to think about growth of being a top metric. So if your committed ARR growth isn't kind of in the range for your stage company, we've talked about the 3-3-2-2-2 model for years, but if you're a $10 or $15 million company, your growth rate's going to be different, right? So committed ARR, revenue growth. Revenue growth, which is GAAP revenue growth, is number 3. And often people say, well, what's the difference between ARR and revenue growth? Well, some organizations, right, are actually driving 20, 30% through other revenue means. Things like, and these are usage-based criteria. It might even be GMV for an e-commerce company, right? It might be number of transactions, because not every SaaS company takes overage revenue and puts it into committed ARR. It just goes to GAAP revenue. So number 3, so we've talked about net dollar retention, which is driven by gross dollar retention and expansion, committed ARR, revenue growth, CAC payback period.
Right.
So how long does it take to pay back your marketing and sales expenses you invest in gaining a new customer, right? How long does it take to pay back on a gross margin adjusted basis? Because if you look at CAC ratio or SaaS magic number, it's not gross margin adjusted. So with CAC payback period, since it looks at your gross margin rate, it's a multivariate input formula. It might be, how efficient am I with marketing and sales investment to get a new dollar of ARR? But my gross margin also might be too low. I might be at 64% gross margin, and my cohort says for subscriptions I should be at 72 or 74%. Well, that 8 to 10% difference might reduce your CAC payback period by 2, 3, 4 months. So CAC payback period, very important. And then as you have 3 to 4 years of operating history, we truly do believe that customer lifetime value to CAC ratio is very important, because it not only factors in gross margin on ARR brought in, it factors in your churn rate.
Exactly.
Because gross margin and churn are the 2 major variables that determine customer lifetime value after your average revenue per account number.
As well as probably retention rate is your net retention rate. So I think that all drives back to one kind of core factor, is like, how valuable is your product? If people are sticking around, I mean, at the end of it, right, that's what those numbers paint the story of, like, how much do people value your product? How much is it actually, do they like it? How long are they sticking around? And do they see the value of continuing to use it? And I think that's really what investors want to see by looking at those numbers, right?
That brings up a really important point, because I have a podcast, and in fact, going to be a guest on the Metrics to Measure It podcast. And we talk to a lot of customer success and CEOs and founders. And I just had an interview the other day, and we were talking about the evolution of customer success. What's the primary purpose of customer success? And you're going to get different feedback from different people you ask. But she answered it, and I thought it was so spot on. Customer success owns that the customer's achieving customer value.
Right.
They know what the measurable value is. And it's not just the user, because the value that the user is getting, it's got to be translated into the business value that the CEO and CFO care about, right? So she said, customer value is number 1. So when you do your quarterly business reviews with clients, or you talk to the clients, or you do surveys of net promoter score, et cetera, don't forget the business value. Can you link everything they say back to tangible business value? So to me, it's all about business value.
Love it. Love it. I agree with that. Ray, I want to kind of switch gears. I want to start off, sharing a little bit kind of about your background. You mentioned about the kind of 5 exits in you have. What's kind of your experience, and why are you the guru in B2B SaaS with all the experience you have now, up until recently you found and co-founded CEO at RevOps Squared?
Yeah. I'm definitely not a guru, but I have a lot of experience and a lot of learnings from mistakes I made and from some of the successes I've had. So I think the most important thing for anyone listening to our podcast today is always be learning, be a student of the industry. Because what I knew 20 years ago, it informs things I do today, but it may not be as relevant to making good decisions today. So always be learning. So, exits are different, right? Exits sometimes are opportunistic. So I started my career, as I mentioned, at GE and went through their executive leadership development program. And then I had a chance to apply some of that more senior management experience to Netscape. Now, Netscape, for those of you who listen to the SaaS District, it was the first big internet software company. It created the browser, which provided and democratized access to the internet. And they then wanted to go into the enterprise, so they created enterprise server software, things like your internet servers, and I ran their e-commerce application group. So we had 5 applications, 3 business-to-business applications and 2 business-to-consumer, like online catalogs, an online publishing tool. We had a B2B purchasing tool and a B2B selling tool. So the reason I mentioned that was the biggest experiences that I get from the 5 exits. And by the way, the thing I don't promote is 2 burn downs. So 2 burn downs, right? Which one company I raised $18 million in a Series A. This was in 2000 and mid 2000.
Yeah.
And then 2 years later, we sold it for less than $4 million. So that's not exactly a success, right?
Right.
But my learning from that was even more powerful. And I'll give you an example of the learning from that, right? We had one really big customer, Cisco.
Yeah.
And Cisco, right, they saw this little startup and they're like, we're not going to give you this $40 million contract right away. And it was a $40 million contract. We had a proof of concept. And it was a 6-month proof of concept with real tangible milestones, performance milestones. Mm-hmm. We invested $8 million to build out our data center infrastructure. Because back then, there wasn't the cloud infrastructures like AWS. Mm-hmm. So you had to get the co-location space. You had to get all your server and your network equipment, et cetera. So, and we had no commitment beyond the 6 months. And after 6 months, the dot-com boom happened. Our software really didn't quite perform as well as we thought it would. So they said, we're done. We're pulling. That $40 million conversion is done. Wow. And we're like, we just invested overall with people, hardware, et cetera, 70% of the Series A we raised. And we had no other paying customers. So what did that teach me? Well, that said, number one, be very careful of building a product and investing so much money on one big potential customer that's not legally committed. But you think about it, you get that one big behemoth potential customer, Cisco back then, we're going to close 10 more deals when I hear that Cisco's a customer, right? Having all that concentration is high risk. So how did that inform the next early stage company I went to? 2 things. Number one, not only did I not invest a lot of money without a legally binding revenue committed contract, I never wanted concentration over 10%. So even in an enterprise company, I had a couple times where I had one customer that represented 20 to 30% of our revenue, and we had the chance to grow that customer even more. So, but I took the entire team and I said, how do we get the next 10 customers so we can get that customer down to less than 10% of total revenue? So that was a big mistake and a really bad learning I had that changed my entire concentration and go-to-market strategy going forward. So that is one learning. I'll give you another learning. Sure. I used to be very focused on close rates. Yep. When I ran sales and marketing and services, in enterprise, we have $100,000 or $200,000 average deal value. Close rates are important, right? Because you don't need to generate more pipeline to get more revenue. If you have a higher close rate and increase your ACV, you're going to grow faster. Right. So I really focused on sales process, the qualification criteria. We took our close rate in 2 quarters from about 21% to 32%. Wow. You'd look at me and say, wow, what a huge success. But at the same time, I took my eye off the demand generation ball, both from a marketing outreach perspective, but equally important from a sales outreach perspective. All my incentive was making quota and getting your ACV up and your close rate up, but there was no pipeline generation being done by the sales team. Think about what happens if you're improving your close rate, you're not generating pipeline. For a couple quarters, we were heroes. The board said, oh my God, this is the most improvement I've ever seen from a sales organization. They were raving about me. Right. 2 quarters later, they're like, Ray, what's happening to your growth?
It's dried up.
Yeah. And we weren't making our number because I couldn't squeeze more out of the existing pipeline. You had to go generate more pipeline. So that's why I say to every founder, don't be a slave or beholden to a single metric. Because you got to think about the interplay and what happens 3, 4, 6 quarters out.
Yeah, exactly. It's all tied together. You can't just be focusing on your one kind of, narrowed vision. Can you just share, like, just for kind of context for people listening in, with these companies, typically, have you worked with, typically working with bootstrap companies, or all these, have raised capital and they're venture funded at a lot larger stage?
So I'll give some company names and kind of some profile. So Netscape was venture backed, went public, right?
Yeah.
So that was a big win. And then we were bought by 2 big companies. So IPO and then a strategic acquisition. When I was at a company called QRS, Quick Response Services, it was a publicly traded company. And I went in and ran worldwide field operations, marketing, sales, services, customer success. We're about a $150 million company. So there, our biggest issue was we had acquired 7 technologies, 7 companies, and we hadn't integrated them either from a product perspective or from an organizational perspective. So we had 6 sales organizations, 6 service organizations, et cetera. So there, it was all about integration, making bets on what are the 2 or 3 areas of growth. And there, we just weren't growing fast enough for the public market to want to buy our stock. And this was 2001, 2, 3.
Okay. So just to be clear, what's not growth fast enough for you in that time frame? I'm just trying to compare it.
We were growing 10% a year.
Got it.
When I went in, they actually had decreased 4% year over year. So we went in, and within 12 months, we had increased our top line growth to 10%. And back then, for that company, that was a big win. We rationalized it. We took out a hell of a lot of cost to kill. So we also increased our profitability from 18% EBITDA to like 28% EBITDA, right? So in a public market, when you trade on earnings, that's pretty important.
Right.
But as we looked at it, we're like, we're not going to be able to really grow fast enough to really have the public market buy our stock. So we looked at strategic options. So there, we actually ended up accepting an offer to be bought by another large strategic enterprise software company. It was called JDA at the point in time. They were about a $300 million company, and they're still around. They bought companies like i2, Manugistics, et cetera. But in the middle of the definitive agreement, they actually missed a quarter's guidance because they were a public company also. Their stock went down 28%. It was a stock exchange. So the market cap of our company went down 28%. So we pivoted, and we had 3 private equity companies all bidding for us because we had created a little bit of market frenzy that, this company that's got 10,000 paying customers, they've got a number 1 market share in that industry. It was Universal Product Code Catalog for the retail industry. And we created a buying frenzy. So we sold to private equity. Then the next company I was at was a company called Accruent. And Accruent was a leading company in real estate performance management software for retailers. We had Starbucks as a customer, CVS, Home Depot, et cetera. So there we were about only a $5 million company. During my tenure there, we got it to a $40 million company, and we grew it in about 2.5 years to that level. And we ended up getting bought by Vista Equity. Why? Because Vista saw Accruent as a platform that they could consolidate a lot of the small fragmented players onto. And that's what a lot of private equity does, especially Vista. They want to buy a company that they see as a platform company to tuck in acquisitions of point solutions. So as a founder, one of the things you should always be thinking about, and I had Tom Riley, and Tom Riley was the CEO of Cloudera when they went public, and he raised $900 million from Intel as a strategic investor. He will tell early stage entrepreneurs, always be looking at your strategic partner ecosystem, not only as a way to accelerate customer acquisition in markets that you may not be known in. Like Intel for them was to get into the high-end enterprise data center type vendors. That strategic partnership became a step into either an investment or an acquisition. So a lot of companies today will look at Salesforce and they'll say, well, Salesforce is the 800-pound gorilla in SaaS, right?
Right.
So I want to be acquired by Salesforce. Founders think this, like, what's your exit strategy? Well, either Salesforce or HubSpot will buy us, right?
Yeah.
So my recommendation, and more importantly, Tom's recommendation is when you reach out to potential partners, the whole discussion should be what value can you add to them? It's not about how they accelerate your customer acquisition and your growth. It's, hey, I've noticed this is maybe a missing functionality in your product portfolio that we think we can fill, or it's an industry or a regional customer base that they can't fill. It's like, how do you help them? That's what's going to lead to a potential strategic acquisition. So going back to my experience at Accruent, we looked at Vista and we knew that they were trying to consolidate this space. And there are funds out there that's what they're looking to do, is consolidate a space that's too fragmented. Look at the acquisition that was just announced today. ZoomInfo bought Chorus AI for $575 million. So if you look at that, here was a strategic acquirer that was looking at the landscape that they serve, which is kind of that sales technology landscape or revenue landscape. And Gong is the 800-pound gorilla, right? What did they just raise? Over $100 million at a $7.25 billion post money. So if I'm Chorus, it's like I had a strategic partnership already with ZoomInfo. What better acquisition is there, right? You're not number one. You're probably not going to be number one. So go to a strategic partner who's looking at consolidating this entire revenue intelligence platform marketplace.
Yeah. So kind of adding to that point, I'm curious your thoughts. So, you have the one way, if somebody's looking, I'm a SaaS founder early stage and maybe looking to start my new startup, or I'm just starting off, first time founder. And there's a couple ways to look at it. One is, okay, these are some big players that I want to build for and eventually sell to. And then there's also, looking at the data that you have and you probably analyze and say, these are some hot markets. They're growing fast. They're getting higher multiples. Is there any, specific industries or certain markets that you would really focus on, and if you were to start a SaaS company today, and you really, get excited about?
Well, first of all, my biggest advice is if you're a founder, build a great company. And don't build it for the exit strategy. Build it for the passion that you have, the industry or the process that you're trying to improve, and you're trying to improve your customer's business. At the end of the day, don't build a company for an exit, build a company to build a great company. So that's my first thing. Now, if you're thinking about where the market's going versus where it's been, right? So I think if you can combine content/data and forward-looking technology, specifically around AI and machine learning, I think that's one really interesting area. Because you see how much money is going into AI and machine learning. And honestly, a lot of investment communities are followers, or they're fast followers, right? I've got to be in CRM, or I've got to be in marketing automation, or I've got to be in cybersecurity. So I think content/data plus AI and machine learning is a huge market opportunity. As an example, if you're providing a forecast management piece of software, that's wonderful, right? And a lot of forecast management software today has AI and machine learning. One person's opinion, I would probably build a company that in the contract, I say, we have the right, Mrs. or Mr. Customer, to anonymize and aggregate the data, the information that goes into forecasting. And the benefit is, I'm not only going to let you automate the forecast process, I'm going to provide you feedback that based upon your pipeline and your heuristics, here's probably what percentage of your pipeline actually is going to close. The last research we did was less than 50% of deals that are forecasted to close in a certain time frame close within that time frame. And 68% of companies were satisfied with their forecasting process. How can you be satisfied with something that you're less than 50% of the time you're right?
Exactly.
So that's one market I see that's ripe, is taking content and data and combine that with machine learning and AI.
Yeah, the hard part is just getting enough data, right? That's the hardest part.
And that's in any industry and any process.
Yeah, I agree. This has been really, really fun, Ray. Coming close to kind of the end of the podcast today, just want to ask a couple of, rapid fire questions on a little bit more personal level. with all your experience you have, looking back now, if you were, talking to your 25-year-old self, what's maybe one piece of advice you wish you had known and would tell yourself then?
Yeah. I think the most important thing anyone's ever told me is to be able to look in the mirror every morning that you wake up and be happy with the person that's looking back at you, right? That you don't take shortcuts. Integrity is never questioned. So someone told me that when I was 25. So that's the one thing I would say is be able to look in the mirror every morning and like who you look back at. I won't go into the details, but I turned down a job in 2000 that the person who took it was a second place candidate, made $40 million in the next 2 months, and not 2 months, in the next 2.5 years. I never look back on that decision and say, I lost $40 million. I look back on it and I said, I wasn't comfortable with some of the values and I was going to be sacrificing my own value system and integrity. So that's number one. Number two, the power of relationships. I always thought it was more important to be smart, successful, driven. I'm very competitive. And I would probably not put enough emphasis on the value of relationships over time. The reason I mentioned that is I burned a couple bridges with very influential people. And I was right about the topic. I was wrong about the way I went about it. And you don't know what you're talking about. You don't tell one of the top 5 people in the industry that they're stupid, right? Which I did because I knew I was right. So
your ego speaking there, right? You can try to control your ego, I guess so.
Yeah, control your ego and build relationships. Another thing, and I've told everyone this my entire career, if I worked with people, whether they were 2 levels below me or 2 levels above me, I reach out before we had social media every 6 to 12 months. And I would reach out and just say, hey, how you doing, Akil? Right? Just wanted to see how you're doing. Here's some things I'm working on. What's kind of been new and exciting for you? And people were amazed. So Ray, how do you have people like Byron Dieter? And Byron is one of the best VCs in the industry, right? I met Byron 20-some years ago, and I'll still reach out once a year and just see how he's doing.
Yeah.
And if I need advice, I'll say, hey, any feedback on this? But far too many times, people only reach out when they want something or need something.
Of course,
right?
yeah.
How many times have you had a former employee that you haven't talked to in 8 years, but they reach out and said, I'm looking for a job? It just doesn't feel good. So turn that around and say, keep your relationships warm because you're genuinely interested in the person and or you think you have something of value to them.
Love it. Ray, what does success mean to you today? 5 exits, whether it's personally, business, financially, life, no right answer. How do you measure your own success?
It sounds so canned, right? But number one is it really is giving back. It's giving back to an industry that has provided me and my family more than I could ever have thought of, from a poor little farm boy in Ohio who didn't even know anything about business, right? But giving back, the way I'm doing that is through RevOps Squared, believe it or not. So we talked a lot about being metrics informed, have data-driven decision making. We will never, ever once charge for our benchmarks because I believe that especially earlier stage founders and CEOs and even operating executives, if they have access to benchmarks that provide them some context of where their company should be performing at across multiple processes, whether it's acquisition, retention, expansion, et cetera, then they can make better decisions. And our industry, the SaaS and cloud industry, is going to become more mature. Right. And when the excitement and sizzle goes off the cloud bloom, and our value is going to be based upon financial fundamentals like earnings per share, net income, operating profit, et cetera, that our executives of the future know how to run a business based upon data and financials, not just based upon momentum and buzz. So giving back through these benchmarks, never, ever charging for them is the most important thing to me. Number two is helping earlier career people kind of maneuver some of the more difficult decisions they need to make. My advice is just one person's advice, but it's informed by both my experiences, my mistakes, And from the constant learning that I'm doing, one of the reasons I love these benchmarks and doing all these research projects, I'm learning. Every time I had a podcast guest on, Akil, to me, that's not about getting another 1,000 downloads or another 3,000 downloads. It's about me learning and allowing our listening audience to learn.
Right.
So learning is the other thing that's most important to me.
Love it. This has been awesome. I really appreciate you jumping on today, Ray. Last question, where can founders listening in get in touch with you, learn more about you or RevOps and kind of the benchmarks you guys have?
Well, definitely everyone can visit RevOpsSquared.com. That's our website. It has both access to all the benchmarks, all the executive reports we've done with the companies I talked about, the Hubspots and demand base, et cetera. And I'm big on LinkedIn. I love LinkedIn. It's my number one social media platform. So it's just Ray Rike. Mm-hmm. In fact, one of my claims to fame is I'm user number 256 on LinkedIn.
Okay, cool.
My good friends was the co-founder, so I got in very early, right?
Nice.
So LinkedIn, and then at Twitter, I'm at Ray Rike on Twitter.
Okay, awesome. Thank you so much, Ray. Really appreciate you jumping on again.
Okay, Akil, it's great talking to you. Thank you for having me on your podcast.
Thank you. Thank you all for listening in to this episode and joining SaaS District today. Don't forget to leave a review and subscribe for future episodes where we interview top leaders in the SaaS industry. If you're a SaaS company looking to grow and unlock the true value of your business, get in touch with us at horizoncapital.com. And myself or one of our consultants will provide a free assessment to help you get there and hit your goals. If you have any feedback or suggestions for this podcast, please DM us on Instagram or LinkedIn at Horizon Capital and help us improve our content for you all. Thanks again and hope to see you on the next one.